Hello, this is Mark from Tradinformed.com and welcome to this video on a Forex breakout strategy. In this video I'm going to be demonstrating a long-term Euro USD breakout system. Before I get into the video, I'd just like to remind you that if you like this video, please hit the like button, and if you want to see more videos like this about trading the financial markets and trading strategies, please remember to subscribe to this channel. Also, there is more information below this video, so please remember to check that out for more information. So I've got on the screen at the moment the Euro US dollar on the daily time frame. I've got the candlestick bars here, and in blue you can see the channels. Now these are Donchian channels. They are set to 55 periods, and using these channels we can have a nice visual representation of a breakout. So anytime these channels are pushed upwards, we have a long entry or a potential long entry, and every time they are pushed downwards we have a potential short entry. So we have a breakout here and a break below for a short entry here. So we can see on the charts that we have some very big moves. Obviously we have, if we look at it here, we have a huge move here. Which one was this? Was this the Brexit move here? In June 2016, we have a huge move here. Market obviously subsequently recovered quite well, almost in fact broke out to the upside, but then continued downwards some months later here, and we have the continuation of the move here. And we've got a breakout for the first time in something like a year to the upside here, and we have this move continuing to the upside. So we can see that in a breakout strategy there is the potential for grabbing big moves. The other advantage is you can't miss these big moves, because any big move is going to have had to break out from a range at some stage. The danger, as I'm sure all of you know, with a breakout system is when the market is flip-flopping back and forward, and instead of using these lower ranges to break out, it uses them as support and immediately goes back up again. So for a strategy to work over the long term, we need to understand, how does the market work? We need to understand whether it's a good idea to use a shorter number of periods or a longer number of periods. We need to know whether we should be using a stop loss, and if so, what sort of values should we be using, whether or not we should be using a profit target, whether or not a trailing stop, a chandelier type stop is appropriate as well, whether or not we should be using some sort of buffer here, giving the market a bit of room and then entering when we have a breakout of the wider buffer. So how can we answer all those questions? Well, the one obvious way that I think we can use is we can see what has worked in the past. And the way that I'm going to do that and demonstrate in this video is using this Excel spreadsheet. Now this is a Tradinformed Backtest Model built in Excel, and these models can be used by traders to test their own trading strategies. It's very easy to change the data, shown over here on the left. We've got technical indicators, very small number of technical indicators because breakout strategies tend to be fairly simple. And then we have the calculations, we have long and then short trades shown over here. Now the model has been set up, as I said, for a breakout here, and we've got our upper range and our lower range exactly the same as shown on the chart earlier. We've got the average true range, got an exponential moving average, and then over here, if I'm going to scroll down a little bit further, we can find a breakout trade and see what it looks like. So at this point here, the high point of this bar went above the upper range, and so we entered long, and we're going to follow this all the way until the position breaks below the 55 line in the opposite direction to the short side. And if I scroll across here, you can see we have entered a short position at that time. Now we've got lots of different values that we can look at when we are using a Tradinformed model, and I'm going to go through them here. So we've got a notional amount of starting capital. I'm not going to look at spread for the time being, but I will come back to that. Now you see we can set here a profit target and a stop loss. Now I've set up this model using 17 years worth of data. We're going back to 2000 to 2017 as we are currently, and we've got the profit target there and a stop loss. So neither of these are being triggered. These are based on a multiple of the ATR. But if I make these slightly lower values, I can set the stop loss 10 times the ATR or 5 times the ATR, and we can see that it starts to have an effect on the results and the capital graph over here. I can change the profit target. I can set it to 10 times the ATR, set it to 3 times the ATR, and we can see instantly how it affects the capital graph. Now, a lot of people will trade breakouts using a trailing stop. An ATR based trailing stop means that the position will automatically adjust for volatility, and we can set that to different values and we can see how it affects the results. Now, one thing that you might be interested in looking at is the maximum risk. Now, the maximum risk is a very significant factor because every trading strategy will have drawdowns. You may want to risk a smaller or a larger proportion of your capital. So you may think that risking, say, 5% with a 5 ATR stop loss is too great. So you can put this way down here and you only risk 0.5% for a 5 ATR move. On the other hand, you may need or want to have more risk, and you can simulate what is going to happen. So if you stick the leverage up to 5 times there, you have a maximum risk of 25%, and you can see you have quite a crazy capital graph, which is a bit of a warning. The thing that I would be very concerned about personally is the max drawdown. So if we stick that back to 1, we can see that if we stick the leverage back to 1, we can see that the maximum drawdown here is 25. If we put it divided by a quarter, we have a maximum drawdown of 7%. And you can see that the risk in the strategy is automatically being reduced by trading a smaller position. Okay, so we can do other things as well. We can change the number of breakout periods. Now, 55 is a very common number, influenced, of course, by the turtles. So we can try, maybe we want a shorter breakout period. We can try 20. Oh, maybe we want a longer one. Maybe we want to try 75, 100, or 150. And we can see we're going to get different values, different results, and a different capital graph. So I've set it back here to 75. Now, entry offset is another factor that we can have in developing a breakout strategy. Now, the entry offset here is set in multiples of the ATR. So if I set it to 0, it means that as soon as we hit the Donchian channel, the high point of the previous 75 bars, we will have an entry. But maybe we want to offset this by a certain amount. We could offset it by 0.5 of an ATR or 0.75 of an ATR. And we can see that things like the win percentage is changed. Things like the profit factor is changed. And we see how one of the ways that this has been achieved is by having far fewer trades over this long period. So we've got here trades that are being held for quite a long time. If I set this all the way up to 2, we see we hardly have any trades at all. Okay, I said I'd come back to the spread percentage. This is a way of adding a bit more realism into our strategies. We've always got to be realistic because we're going to find out one way or another the problems of a strategy. So the spread on the euro US dollar is quite small because it is by far the most commonly traded Forex pair. So we've got a very low spread. However, if we hold a position over time, then we're going to have to pay the cost of holding that position over time. So we've got to account for that somewhere here. Also, another factor to consider, if you're trading a breakout strategy, there is always the potential for slippage because you are entering on a stop order. Market can move very fast through these levels and mean that you don't always get the best entry price. Equally, if you're closing with a stop, you have the potential for the market zipping through the other way and giving you a less than perfect exit. So the way to account for this is to look at what would happen if you have certain values. I've just called it the spread here, but it could be the spread cost of trading. So if we start to add in cost of trading of 0.5%, and we can see it has an effect on the net profit and the profit factor of the trading strategy. So we can get a realistic idea of how the strategy is likely to perform in the future based on how it has performed in the past. Now, I hope you enjoyed this video. For more information about trading the financial markets, about backtesting trading strategies, please go to www.tradinformed.com and please remember to subscribe for more videos like this.